Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning, or good evening, or sorry, even a good afternoon, of course, depending on where you are around the world. And welcome and thank you for joining me tonight on tonight's latest episode of How I Got to Grips with Trading. Written by myself, of course, James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Tonight's episode is How I Got to Understand the Different Market Environments, Part 1. Like I said, written by myself, which is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, before we get on to an introduction on myself and a rundown of the agenda tonight, bear in mind we are talking about online trading and CFD trading, and like with every type of investment, it does indeed carry a great deal of risk. So I do suggest you do your research and your own due diligence and know the risks at hand before entering any trade. Now, this hairy, wrinkly individual, God, I do look wrinkly in this picture, is myself. Like I said, my name is James Trescothick, and I'm the Chief Trading Educator here at Stratton Markets. I have over 20 years experience in the financial service industry. I actually started off at the age of 18 as a mortgage broker, specializing in buy-to-let and commercial mortgages, before moving into pensions. And it was pensions when I noticed that actually we were facing a potential pension crisis. So that's when I got involved with trading. Okay, and I actually started off as a prop trader, trading for several companies. One in particular in Dubai, where I traded for the Dubai Gold and Commodity Exchange, where I traded gold options. Ran a floor at the Philippines Stock Exchange before going into portfolio management, and then of course later on down in education. I'm indeed a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, City AM, and several newspapers, just to name just a few. But as well as that, I am an avid market commentator. I'm very passionate about the markets, and I follow them because obviously I'm a trader. So I talk very openly about the markets. I'm very passionate about it. And I'm a well-known public speaker. And I've spoken at several events around the world, including the likes of Singapore, Hong Kong, Dubai, Kuwait, Qatar, Bahrain, Philippines, Berlin, London, and just a few off the top of my head. Now, tonight's agenda, okay, of course, I'm talking about different market environments, i.e. if the market is trending or ranging and how to recognize it, and how to look for possible trading opportunities. Now, an awful lot of my stuff I'll be talking about I will refer to it a lot, will be the support and resistance. So I thought it would be a good idea to just do a quick reminder of what support and resistance is, because I'll be referring to that a lot. Then, of course, I'll be talking about a trending market and how to draw trend lines. Then I'll be talking about one indicator you can use with a trending market, which is an SMA fan crossover. I'll talk about that. Then I'll talk about a ranging market and channel lines. And then I'll talk about a ranging market and, again, using the indicator Bollinger Bands, again, to recognize possible opportunities, etc., like that. And then we'll do my usual question and answer session. So if you have any questions, please feel free to ask me at the end. Put myself on camera here so you can see me. Hello. Hi, yes, I still haven't got a haircut yet, but I will get round to it. So anyway, what is a support and resistance? Support is a level where an asset could fall, and then fall to, shall I say, and then the market starts to buy in again. So it acts like a trampoline. So you see an asset coming down, touch the support level, and then all of a sudden you'll see it start moving back up again. So the market starts buying in. Resistance is the opposite. It's a level where an asset could rise to and the market starts to sell from. So it's like a ceiling. So an asset could rise, touches this level, and the market thinks, no, we're not having this, we'll sell it off. Now, traders look for support and resistance levels to engage potential entry levels in a trade, but also to use as maybe a potential stop loss or a potential take profit. Now, this is what you'll see at times, and this is the things when you can often, the big question I often get is when do you know if a level is broken or not? And there is no solid written golden answer that a level is definitely broken. Some say when a candlestick opens and closes above it. Others say that it's when the support and resistance changes its roles. Because what you can see is to say if a support and resistance is indeed broken, then it changes its role. I.e., for example, the support becomes the resistance and the resistance becomes the support. Like this, for example. So there we go, on this little crude animation I've done. Say that's our support, the asset breaks below it, then retraces back up, and it then acts as resistance. The market starts selling from it. So when it changes its role, that is sometimes how you can see if indeed a level is broken. And this is why it's interesting to try and identify support and resistance, not just for entry levels and stop loss and take profits, but really because if it is indeed broken, then of course indeed you then know where the next resistance support is, and indeed if that level has been broken, if it has indeed swapped roles. Now, what is a trend? Obviously, a trend is a trend as an uptrend or a downtrend. So an asset going up or an asset going down. And wouldn't it be really easy? Life would be so easy if it just went on a straight line up or a straight line down. But in reality, we all know it doesn't do that. Instead, what we see an asset, if it's on an uptrend, does something like this. Slowly moving up, as well as being sold off at certain levels, or on a downtrend, going down, something like this. So this is where trend lines come in. This is so when you're on like a trending market, uptrend or a downtrend, it's like I'm doing an ABBA dance move. This is where trend lines come in quite handy. Okay, so a trend line, and again, you can draw this yourself with your naked eyes, where you need to train yourself to spot it. But a trend line is a line connecting two or more lows, if it's an uptrend, or two or more highs to indicate future price movements. The theory is that two lower lows and two lower highs indicate a downtrend. So you've got an asset going one low and then another low, which is lower, and at the same time the asset's got a high and a lower high, that's a downtrend. Whereas the opposite, if you have two higher highs, like steps, and two lower lows, like that, that is a potential uptrend. Now, traders use trend lines again to identify if an asset is on an uptrend indeed or a downtrend, and for areas of interest. So it'll be a bit like this. So here we go. This is like this. So this is my crew animation again. Up, down, up, down, up, down, up, down, up, down, up, down. Draw the trend line. Let's get my pen here. Laser pointer. So as you can see, for example, lower, low, higher, high, and that's how I know then if an asset is potentially in a uptrend scenario. If the opposite, obviously two lower highs and two lower lows, will illustrate a downtrend. But we then draw the trend line there to confirm in some ways that the asset is indeed in either an uptrend or a downtrend. But again, also to see areas of interest which could potentially then act as a support or resistance. So here's an example. Okay, this is the sterling, okay, on an hourly chart. So I connect my lower lows, and as we can see, every time it's indeed come round that trend line, the market has indeed bought in again, pushing the asset higher, confirming indeed that on this occasion, this chart, this occasion the sterling was on an uptrend, and it gave us a level of support where we could possibly buy into. Let's look at another one. This is sterling again. This is on a daily, and again, same trend line matches on a daily, shows indeed that at this period of time when this chart was done, it was indeed on an uptrend, and that trend line acted as a support. So basically, when the asset came down, the market started to buy in again, pushing the asset higher. Here's another example. This is indeed the what's this one? Again, sterling again on an hourly, but it's not always the same. You can also see in a downtrend as well. Again, an asset on the downtrend connecting the lower highs. So instead, it then acts as a resistance, and as we can see, this is the euro sterling, I believe at the time. As you can see, every time it came to that trend line, as it was downtrend, it added resistance, pushing that asset lower. But here's the rule when it comes to drawing trend lines. A little sweet of my green tea. I'm healthy today. Here's the things to remember. There is 3 cardinal rules when you're drawing trend lines. First of all, trend lines can only be drawn when they are indeed at least 2 tops or 2 bottoms. Trust me, that's not rude. The steeper the trend line, the less accurate it will be. So if you're forcing it, drawing it based on what you personally believe but not what you see, then it's unlikely to be very accurate. So remember, at least 2 tops, at least 2 bottoms. The steeper the line, the more you force it, the less likely that line will indeed act as a support or a resistance. But of course, there is other ways which can help you when you're looking at even if an asset is on a downtrend or an uptrend, and for potential trading opportunities. One is using simple moving averages. Now, those who've attended my episodes on simple moving averages in the past, I've done a lot on moving averages. The theory, remember, is if an asset is trading above a simple moving average, it's on an uptrend. If an asset is trading below, it's the moving average in my hand here, below the moving average, it's on a downtrend. But there is also another theory that you can use 3 different types of moving averages to identify a trend, a potential downtrend or a potential uptrend. And theory is if you use a simple moving average of, say, 7, so closing price over 7 trading sessions, and a simple moving average over a period of 20, so a closing price over 20 trading sessions, and a simple moving average period of 65, so over 65 trading periods, there is a way you can use these 3 SMAs at the same time to identify if an asset is on a proper downtrend or a proper uptrend. And this is how this theory works. Now, on my chart here, okay, I have a simple moving average of 20, which is the red line. Then I have the simple moving average of 7, which is the blue line. Then I have the simple moving average of 65, which is the green line. Now, the theory is if the 7 crosses above the 20, and the 20 then crosses above the 65, that indicates an uptrend. If the 7 crosses below the red, or the 20, and the 20 then crosses below the 65 and fans out, that indicates a strong potential downtrend. So this is one of the charts I took today. This is indeed the dollar Japanese yen on a daily. So let's have a look. So what we have here, the 7 is above the 20, and at the same time the 20 then covers the 65, meaning both the 20 and 7 are above the 65 at the same time, indicating a potential uptrend. And what indeed happens, and there again, what do we see? The market does indeed rises on an uptrend. We then see at this point here, the 7 is below the 20, and when the 20 then breaks below the 65, what do we see? We then see a downtrend. Then at this point here, okay, we see the 7 above the 20, but it's yet to cross above the 65. So it's showing us potentially an uptrend, but it's not a strong enough uptrend until it actually moves above the 65. Here's another one, the British pound, US dollar, or the cable, again on the daily. The blue crosses below the 20, or the 7 crosses below the 20. Both are below the 65. What do we have? We have a downtrend. The 7 crosses above the 65, but at the same time, so does the 20, indicating what do we have? A potential uptrend, and indeed the market moves higher. Here's another one. This is euro dollar on the daily. Both the 20 and the 7 are trading below the 65, but when the 7 fans out and does indeed break below the 20 at the same time, so both are below it, we have a downtrend. When they both cross the 65, then we have an uptrend. When they cross below it and they're both below it, then we have a downtrend. When they cross both above it, like they do at this point here, we then have a strong uptrend. When they both, beginning when they're not quite, they crossed there. This is actually, like I said, I did this chart today. I often do a lot of my charts I take on the day of me presenting, so it's fresh. Some of the other charts are older for older examples, but these charts here I took them today to show that they're fresh. The question mark here, obviously the 7 is below both the 65 and the 20, and the 20 is yet to go below the 65. We are still on a medium downtrend, but like I say, until the red or the 20 crosses the 65, we don't really know or confirmed how much that downtrend is. Now, obviously, trading environment. So we're talking about a trending market when the asset is doing either going up in this direction or this direction, or down, like this direction. We're not talking to you yet about the other market environment, which is when an asset is ranging, a ranging market. And a ranging market is when an asset is trading between the same highs and the same lows for a good number of times, i.e. is trapped between a resistance and a support. So it's going sideways. And depending if you're a day trader or position trader on the market, majority does this. Okay. Now, a ranging market can be defined when the asset is trading between the same support and same resistance at least 3 times or more. So it looks a little bit like this. And this is when you didn't draw it instead of your trend lines. Instead, you're drawing your channel lines. Now, channel lines are like trend lines, okay? But instead of being over underneath an asset, if it's on an uptrend, or above an asset, if it's on a downtrend, it's between those 2 levels the asset is trading between, okay? So again, traders use these lines to look for potential support and resistance, okay? Now, there is other different types of channel lines. So there's 3 types of channel lines. There's actually ascending, which can be used for an uptrend. There's also descending, surprise, surprise, usually a downtrend. Because we're talking about ranging, I'm talking about horizontal trend lines. And they look like this. Yeah, the asset trading between 2 key levels. So you know, this is where the market's bought in again. This is where the market's sold again. This is where the market's bought in again. This is where the market broke. But has the line broken? Did it change its role? No, it broke down, so it hasn't quite broken. After the resistance, and finally it broke. Is that level broken? Yes, it did, because it changed its role and became a support. So let's have a look. There, I tried to break it. Did it break it? It did break it, because that resistance which was holding changed its role and then became a support. Here's another example. we can see where the level initially held as a resistance, broke above it, then it swapped its roles and became a support, and we could then able to draw in our resistance level. So channel lines we can use, horizontal channel lines we can use when the market, like I say, is ranging. There's another method, of course, there's another indicator you could use, and that is indeed Bollinger Bands. Now, I remember I've done episodes on Bollinger Bands, and don't forget, Bollinger Bands, the upper band and the lower band, when they fluctuate, they're closer together. Two pens here, so it makes it fluctuate together. Indicates the market is not that volatile. However, when the two bands then expand like this, indicates the market is extremely volatile. In the case where the two bands are like this, indicates that the market is potentially ranging, and at the same time, the upper band becomes a potential resistance, and the lower band can act as a potential support. So here we go. This is the the Euro British pound on 1 hour. And straight away we can see something obviously happened in the market, and the two bands, the top band and the bottom band, really was wide, showing a lot of volatility. So if we were looking to trade a ranging market, we would ignore that. It wouldn't be till the bands get closer together that we would be interested in looking at the ranging market, because then we know potentially the bottom band acts as a support, the asset comes down, touches, and the market starts to buy in again, and it hits the upper band, which acts as resistance, and the market sells off again, hits the bottom band, market buys in again, hits the top band, market sells off again, hit the bottom band, market buys in again, and hey presto. Here's the Aussie dollar on a 1 hour. Again, this period of time, very volatile. So if you're looking to swing trade or trade a range, we wouldn't really be looking for this. Instead, we'll wait for when the bands get closer together, so we know when the bottom band is touched, we'll potentially buy in and start buying again. If it hits the top band, it will potentially act as resistance, we start selling again, and vice versa. Now, up and coming educational events for the rest of February, we have on the 19th of February. My next episode is how I got to understand different currency crosses. That was going to be a good one, because I'm going to be discussing about some of the minor currency pairs and minor commodities. When people are trading Forex or currencies, they tend to focus, understandably, on the most liquid pairs, which are the majors, the euro dollar, dollar Japanese yen, British pound, US dollar, dollar Swiss franc, etc. Aussie US dollar, example. But there's often some opportunity with some minor currency pairs or currency crosses, which I think is worth looking at. At the same time, they're actually quite interesting pairs to trade if you're looking to hedge. For example, euro sterling, which everybody knows I talk about a lot. Euro sterling is a great currency to hedge with. There's the British pound, Japanese yen, because of the negative correlation. So again, we'll be talking a little bit about that, so that'll be a good episode. Then on the 26th of February, the final one for the month, it's how I got to understand the Elliott wave theory. Again, I think it's a fascinating theory, because really it goes on to a fact about the madness of crowds. You know, what drives people to buy and sell things, and and Bitcoin is a prime example of what happened back in 2017 as a prime example. So yeah, that'll be a good one. That's on how I got to understand the Elliott wave theory on the 26th of February. If you wish to speak to me, you can indeed email me at james@strattonmarkets.com, or you can follow me on my Twitter account, which is @JamesGothic, and by all means, you can direct message me, which, I will answer. Be nice. Now, before I go on to any questions, don't forget, I have been talking about online trading and CFD trading, and like with every type of investment, it does indeed carry a great deal of risk. I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. With that out of the way, is there any questions for me at all? Anybody like to ask me anything on tonight's episode? I have my tea. My green tea. No? Oh, hand up. Didier. Hi, Didier. How you doing? Would you like to ask me a question? Oh, right. Okay, right. If there's no questions, I think Didier just said thank you and goodbye. So thank you, Didier. Nice to see you again. On that note, if you have anybody have any questions later down the line, feel free to obviously contact me by my email or my Twitter account. On that note, a big thank you to everybody who attended tonight. I appreciate that, and thank you. Till next time, depending on where you are around the world, of course, can I have to say either good morning, good afternoon, or good night, well, good evening, depending where you are around the world. Thank you so much for joining me tonight, and till next time, every single one of you, trade safe.